Welcome, everyone. Transparency is the foundation of trust in business. By embracing clear and accurate reporting, we not only comply with regulations but also build a culture of integrity and accountability. Thank you for joining us for today's webinar on reporting requirements for financial year 23-24 with CA Gururaj Acharya. Now, without further delay, I would like to welcome Ms. Uma Satish to introduce the speaker.
Thanks, Sridaksha. It's an honor for me to, introduce Mr. C.A.K. Gururaj Acharya, sir. I know we all have been seeing him as a resource person. So let me introduce formally. C.A. Gururaj Acharya hails from Temple Town of Udupi, brought up in Iron City of Bellary, and is now well settled in the knowledge city of Bangalore. He qualified as a chartered accountant after completing articles with Mrs. Guru Prasad and Co. Bellary. He is presently the senior partner in KG Acharya and Co. Chartered Accountants, Bangalore, specializing in corporate finance, corporate taxes, and company law. And to tell you about his academic achievements, so he has stood first rank in BCom, Gulbarga University, and he has been inter 21st rank in CA All India ranking. He has been 10th rank in CA Final All India ranking. He has been inter first rank in ICWA All India ranking. He has stood third rank in ICWA finals as well. And to tell a little bit more on his, career and achievements. He is the director on the board of directors of Karnataka Bank and the chairman of the audit committee of the board. He was a director on the board of directors of State Bank of Mysore. He was a member of Karnataka State Level Audit Advisory Board. He was a co-opted member of Expert Advisory Committee and Committee on Accounting Standards for Local Bodies by ICAI New Delhi. He was a member of the Bangalore Financial Reporting Review Group formulated under Financial Reporting Review Board of ICAI New Delhi. He has also authored a book titled Internal Financial Control, Practical Handbook on Audit Report on What Can Go Wrong, published by Karnataka State Chartered Accountants Association. And he is a very eminent resource person in the areas of accounting standards, standards on auditing, Companies Act, LLP, corporate finance, financial analysis, corporate tax, and tax audit. So we have been hearing him from a long time, and we know that he's a great resource person. So without wasting much time, I would really welcome you to the session and, hand over this session to you for starting the topic. Thanks.
Thank you, Umaji, for that nice introduction. And thanks to Sri Raksha for co-hosting and for hosting this program. And a great thanks to Abhilasha, who is behind me, to talk during the season when we should actually be talking less and working more. But having said that, it is always better to learn instead of just doing the work by doing some mistakes. I think that is the focus of this topic. For today's session, I'll be talking on basically the Companies Act requirement with respect to audit trail and other amendments. MSME related, I may digress a bit to go into 43BH of the Income Tax Act because it has gained a lot of importance by virtue of the 43BH income tax, although MSME was there for a long time, and then the common avoidable mistakes. And I wouldn't go beyond 7 o'clock because 7:10 I have another appointment. If there are any questions, I will definitely take it up, but I will be on a rapid fire mode today because the topic is huge and the time is precious, also limited. So audit trail, the first topic, audit trail and the importance of that from the point of view of auditors is that from last year onwards, 2023 April, there was a requirement for every company which maintains its books on electronic mode to compulsory have the feature of audit trail. And audit trail, then the auditor was told that in his audit report, he has to cover in the report on regulatory compliances, he has to report 4 important aspects with respect to audit trail, which you can see it on the screen now, that whether the company which is having a feature of electronic accounting has the following features. it should have the feature of recording audit trail. And number two, audit trail facility operated, whether such an audit trail facility was operating throughout the year and for all transactions recorded in the software. In fact, I would say there are 5 requirements, because these 2 things, the second one can be split into 2, whether the audit trail facility was operated throughout the year. There is a possibility that it could have been operated from, let us say, September of 2023, because that is when the companies came to us for audit and we told them that this is a requirement, and at that stage they switched on the audit trail feature. So there could be a possibility that they would not have operated throughout the year. So unlike in the case of internal financial controls, which need to be tested on 31st of March 2024, this particular audit trail facility has to be seen for the whole of the year, and not only for the whole of the year, but for all softwares used for the purpose of accounting. It could be software like a payroll software, or it could be like a software used for property, plant and equipment. So it could be a subsidiary software which will not, I mean, let us say we are on Tally, but there are other softwares which are used for the purpose of completing the books of accounts. We need to ensure that all those softwares, including the payroll, the property, plant and equipment, or what other any other software which forms part of the books of accounts, should also have this audit trail feature. And audit trail feature has not been tampered with. So once it is there, it cannot be, say, September we started, and maybe in the month of March 28th we wanted to pass certain entries, we switched it off, and again we switched it on. So it should not be a switch off and switch on once it is switched on. So that's the aspect which needs to be reported. And having had all these features, we need to preserve such of the record, the electronic record with the audit trail feature for the period of retention that is required by the statute, which is 8 years. So for this year, we will have to comment only on the 3 aspects and not on the 4th aspect, but we will comment on the 4th aspect, saying that during this year, that is not applicable, being the first year. From next year onwards, we will talk about that. So this reporting on audit trail is required not only for standalone financial statements, but also for consolidated financial statements. It is required also for a foreign company which is registered in India, as defined under section 2 subsection 42. That should also, I'm not talking of the foreign companies abroad, I'm talking about the foreign companies registered in India. That company also, if you're auditing, then you will have to ensure that the company has the audit trail feature. Otherwise, you need to appropriately report it in your audit report. What is the fine for contravention? Well, there is about 50,000 to 5 lakhs. We'll not talk about that today. So to help the auditors, our institute has come out with an implementation guide, and the implementation guide, in fact, got revised also. Implementation got revised also. We need to see the revised implementation guide to do a proper job. What is the gist of this particular implementation guide? They said that this is the first time in any country that such a requirement is there in the statute. And point number 2, first time the auditor required to report on such a audit trail. And the audit trail must be enabled for all accounting software hosted and maintained in India or outside India, on premises, on cloud, or whether it's subscribed to as a software as a service model. Outsourced or partly outsourced accounting, such as payroll, fixed asset register, software, etc. It could be outsourced or insourced, or you are doing it on your own, maybe by the auditor or whatever. Anybody, the feature of audit trail must be there. Any software, it could be a billing software, GRN software, whatever you are talking about, any softwares, it could be an ERP, all those things should have audit trail feature. Accounts of foreign companies or branches which are consolidated in India must also have the feature. Then auditor must verify the following aspects: whether audit trail feature is configurable, whether audit trail feature was enabled or operated throughout the year. I told you, unlike IFC at the end of the year, whether all transactions recorded in the software are covered in the audit trail feature, whether audit trail is preserved as per the statutory requirement for record retention period, that is for a period of 8 years, which is, again, I told you, applicable from next year, because this is the first year which we are seeing. The preservation, of course, is required for this year, but when we talk about the 4th aspect, it is with respect to the previous years. Noting points on reporting on audit trail: control and IFC must also be ensured with respect to audit trail. So if the audit trail is not there, then maybe the IFC report also will have to undergo a change. While this was required to be changed, no, you'll have to look into the lack of control in case there is lack of audit trail. This was required to be done earlier years also, but this year more so from the point of view of it being a statutory compulsion. Let me tell you, audit trail is a great control, great internal control for the purpose of audit for an auditor. So we used to have in all standard companies. Now in all companies, this which is maintaining the books of accounts on electronic mode, this is made a mandate. So verify the auditor. How will he come to know whether the audit trail has been operated throughout the year and for all softwares? He is told in the implementation guide, like in any other standards on auditing, especially standards on auditing 530, which talks about sampling and test checks. Even for this, you can do a test check to find out whether audit trail has been there throughout the year. Audit checklist to contain various softwares used for accounting and date when an audit trail was enabled. So you'll have to have a checklist of what are the various softwares that the company has, and take into account whether for all the softwares and for all the periods the audit trail was enabled. If not, you will have to suitably report it. We will talk about reporting, but that's what we are talking today. So when applicable, consider involving experts in IT to assist in the evaluation of the management controls and configurations in accounting software. If it is beyond the chartered accountant, he must involve a specialist, an IT specialist for this purpose. The implementation guide also has illustrative management representations, reporting formats, and frequently asked questions for various scenarios. Some of the frequently asked questions, in fact, that is being posed there and answered is, what about master data? Should it have an audit trail? The answer is yes, even for the master data, even for purchase and sales order, even for the PPE register, audit trail aspects have to be there. Should it be there for spreadsheets? Now, the question is, what is a spreadsheet? I mean, in Excel, if you are using Excel, only for the limited purpose of computation, and then you erase it, you don't need it. For example, if you are calculating depreciation, once you are calculating depreciation from the register, or you're calculating the forex gain, the forex losses, it is only for the limited purpose of calculating some interest. You are using an Excel just like a calculator, then you need not have audit trail aspect as far as such spreadsheets are concerned. Otherwise, anything which is a software, any software which you are using must have the feature of audit trail, must have a feature of audit trail. Now, how do we report it? So once that there are implications of audit trail, very beneficial for the auditors to find out if there are any bad adjustments done. Similarly, all these bad adjustments which are done will look like, if you have an audit trail, that it has been erased and rewritten. So for everything which is erased or rewritten or deleted altogether or freshly brought in at a later date, all these things will be visible once you have an audit trail, and it has its repercussions at the audit stage, at the assessment stage, and things like that. One has to be aware of that. So that is why we say it's always better to do an internal audit throughout the year to find out if there are any adjustments required to make then and there. Now, how do you report on the audit trail? Now, all of us know that in the audit report, there is an opinion paragraph, there is a basis of opinion, management responsibility, then the auditor's responsibility, and then finally we also have the report on other regulatory aspects. Under that, we go on saying the agreement with the books of accounts, accounting standards complied, and then there is a special thing with respect to rules. They have talked about 1, 2, 3, 4, 5 until last year. Now we need to talk about the 6th aspect, where we'll have to specifically comment on this aspect of audit trail. Whether, I mean, if it is if the company is very good and has all the audit trail for all the softwares that they have been using, then this is what we are going to talk about based on our examination carried out in accordance with the implementation guide on reporting on audit trail under Rule 11G of the company's Audit and Auditors Rules 2014, revised in 2024 edition. Because as I told you, there was a 23 edition of implementation guide which got revised in 2024, issued by ICAI. The company has used an accounting software for maintaining its books of accounts, which has a feature of recording audit trail. also called edit log in the Companies Act itself. And the same has operated throughout the year for all relevant transactions recorded in the software. Further, during the course of our audit, we did not come across any instance of audit trail feature being tampered with. So all those questions, which were the 4 questions which were asked there, I have answered the 3 questions. And with respect to the 4th question, as regards the maintenance of the past softwares with the audit trail, we need to answer like this. As proviso to Rule 3.1 of the Companies Accounts Rules 2014 is applicable from 1st April 2023, reporting under Rule 11G of the Companies Audit and Auditors Rules 2014 on preservation of audit trail as per the statutory requirement for record retention is not applicable for the financial year ended 31st March 2024. Whereas the first paragraph talks about the having it, then for all the softwares for throughout the year, as well as not being tampered with. The 4th aspect with respect to the recording will be covered in the 2nd paragraph and saying that it is not applicable. Then this is a case where the company has it. Now let's talk about where the company does not have it. You'll just have to say, based on an explanation, that the company did not have the feature of audit trail. You just have to say did not have it. And the question of preservation also, you can continue with the 2nd paragraph. Now there could be a situation where it was there, but not for all the softwares. So that is what I have given in the second observation. Based on our examination, which includes test checks, the company has used accounting software for maintaining its books of accounts, which has a feature of recording audit trail or edit log facility, except in respect of maintenance of property, plant, and equipment records. So we have maintained it for tally, we have maintained it for payroll, and for property, plant, and equipment, it was not there. Therefore, I'm saying except in respect of maintenance of PPE, it was maintained, wherein the accounting software did not have the audit trail feature enabled throughout the year. Further, the audit trail facility has been operated throughout the year for all the relevant transactions recorded in the software, except that the audit trail feature of so-and-so software used by the company to maintain payroll records did not operate throughout the year, or we can say operated only from 1st September 2023 to 31st of March 2024. So I've covered in this both the aspect with respect to a particular software not having it, and also a software having not throughout the year, but for a particular period only. So both the aspects are covered. So further, during the course of our audit, we did not come across any instance of audit trail feature being tampered with. Or it could be a situation where you need to disclaim because it was there, the entire accounting was done by a third party and you did not have access, or he did not give a confirmation as regards the facility whether is available, or he did not allow you to actually do the audit in that particular context. So how will you comment on such a situation? Based on our examination, the company has used an accounting software ABC, which is operated by a third-party software service provider for maintaining its books of accounts. And in the absence of state the type of control report, we are unable, or we were unable to comment whether audit trail feature of the said software was enabled and operated throughout the year for all relevant transactions recorded in the software, or whether there were any instances of the audit trail feature being tampered with. So I have given you the various situations. Now let's talk about a couple of issues with respect to this. Point number 1, if the company does not have an audit trail feature, please do the audit properly and say that it is not there. Give an adverse. I am saying that don't be liberal in your audit report, be liberal in qualifying, because if tomorrow the income tax department or GST department or any regulator for that matter wants to take up your books, today income tax department is not asking you to give ledger extracts, they're asking you for the books of accounts, send me your tally itself. And at that stage, if they feel that the audit trail feature is not there, I am sure that the regulator will punish the company. We saw the penalty for the company, and at the same time he will write to the institute saying that the auditor has not done his job properly, or you know how NAFRA is taking on cudgels with the auditor to say that he's not doing his job properly. It will be immediately noticed. So therefore, if the switch is not put on or the switch is not there at all, I'm saying the audit trail as a switch, if that is not there, please inform in your audit report that it is not there, and then it is the problem of the company to set it right. Probably they may set it right because you have qualified it this year, and next year they may set things right. If you say that everything is good and it is in a proper control and it is there, and it is not there, forever, for all times to come, the company will not probably have the feature enabled, and for all times you carry the audit risk. So that's what I'm saying, point number one. Point number two, there may be, in case, property, plant and equipment, there was no software audit trail. Maybe in your CARO report, it has to be sort of qualified with respect to point number 3(1)AA of the CARO. You may have to say, except for the matter stated by us in para 6 in the report on other legal and regulatory requirements of our independent auditor's report, we report that the company has maintained proper records showing full particulars, including quantitative details and situation of property, plant and equipment. So everything is okay with respect, but except for the audit trail not being present in that particular software. Now, point number 3 to be noted on this particular audit trail, in case you are commenting adversely, it also has an impact on the other paragraphs in your 143(3) reporting. First of all, we talk about agreement with the books of accounts. Then we talk about, proper books of accounts as required by law has been kept by the company so far as it appears from our examination of those books. I mean, we are saying proper books of accounts are maintained, but the books of accounts, to the extent of audit trail not being present, if we have qualified it above, or sorry, actually it is below. If it is if you qualified below, then you will have to bring in these words in the red, except for the matter stated in paragraph so and so below on reporting under Rule 11G of the company's audit and auditors Rule 2014. And then proper, whatever you want to say, you can say. So point number B undergoes a change. And then point number G also undergoes a change. The modification relating to the maintenance of accounts and other matters connected therewith. In fact, if the financial statement, if the audit report is modified, modified could be adverse or qualified or negative. Disclaimer. Then you will have to, in point number G, bring out this. And since this is a matter of modification of your opinion, not necessarily on the true and fairness of the financial statements, but on the books of accounts, you may have to talk about in point number G, the modification relating to the maintenance of accounts and other matters connected therewith are as stated in para 2B above on reporting under section 143(3)B and paragraph dash below on reporting under Rule 11G of the company's audit and auditors rules 2014. So these are the 3 aspects which we need to know on the audit trail. While check whether audit trail is there, if not, be liberal in your qualification. Point number 2, if it is a matter which is qualified or a disclaimer, then you will have to see if it is affecting any of your CARO points, and specifically on property, plant and equipment, if you have commented that that particular software does not have, your CARO undergoes a change, and also in your other paragraphs in your audit report will also have to undergo a change. So with this, we come to the end of the first topic on audit trail. I proceed further. I will not stop for any questions, because maybe questions I will take it at the end. I will finish off my topic in totality. And the second topic I will be talking about is Micro, Small and Medium Enterprises Act. And I specifically wrote there, oops, MSE. Why did I write MSE when the act is on micro, small and medium enterprise? Micro, small and medium enterprise means the act is called micro, small and medium enterprise, but there are no benefits to a medium enterprise. That is why micro, small enterprise only are covered for all the benefits under the MSMEDA Act. So let's get into the next point is, what is the definition of a micro, small and medium enterprise? I have a very simple definition, 550, 250, 550, 250, 5 crores turnover, 50 crores turnover and 250 crores turnover, respectively, for micro, small and medium enterprises, along with the investment in plant and machinery. It is not exactly investment. The return on value of the plant and machinery block as per Income Tax Act, to the extent of 1, 5 and 110 and 50, 110 and 50, 1 crore, 10 crores and 50 crores respectively for micro, small and medium enterprises. So let us not get into this I have a simpler way of defining it. If a company or if a supplier, I mean, we should use the word supplier for micro, small, and medium enterprises. If the supplier has a turnover of less than 50 crores, and his investment in his return on value in the plant and machinery block of income tax is less than 10 crores, both the conditions to be complied, less than 50 crores turnover and less than return on value less than 10 crores, then he is a supplier. A supplier under MSMEDA Act means micro and small enterprise. So he is a supplier. So MSC, micro and small enterprise. That's the first point to be noted. So a couple of things on the definition is, in the turnover, exports have to be excluded. So even let us say a company's turnover is 65 crores. If his exports is 40 crores, then his net turnover, net of exports, is 25 crores. He will still be eligible to be called as a micro and small enterprise as long as investment in his return on value in the plant and machinery is less than 10 crores. Even under plant and machinery, there are certain exceptions. I will not get into the details. So who is a micro and small enterprise? Just because his turnover is less than 50 and less than 10 crores, will he be a micro small? The answer is no. He shall be registered with Udyam. So he should be registered with the regulatory authority and has to produce a Udyam certificate to me. Can traders be registered under micro and small enterprise? The answer is yes. But a very big question mark is, they are registered for the limited purpose of priority sector lending, which means for getting priority payment, or for getting specifically a place under the financial statements as micro and small enterprise, and for disallowance under 43BH of the Income Tax Act. They shall not be considered. Trader suppliers shall not be considered for any of the reporting purposes, because they are meant to be registered only for the limited purpose of getting a priority sector tag for the banking industry. So like I am a director in Karnataka Bank. In Karnataka Bank, if somebody is coming with a Udyam registration trader, then I will get the benefit of classifying him under priority sector, because for the banks, we have been told that X percentage should be minimum lent towards the priority sector, agriculture, MSME, weaker sections, and things like that. So this satisfies only that particular segregation, and not for any other reporting purposes or for disallowances under Income Tax Act. So disclose on the face of the balance sheet trade payables. Now we have seen that what has to be disclosed on the face of the balance sheet is trade payables to micro and small enterprises and to others. That is to be disclosed on the face of the financial statement, where we say that in some of the cases this has not been disclosed, or it has been disclosed as to micro, small, and medium enterprises. The word medium, although is covered in the name of the act, for the supplier, for all the benefit purposes, is only micro and small enterprises. In one of the financial statement which we were reviewing, we saw that this is a mistake, and today Financial Reporting Review Board is taking this as a mistake which will be punished, even if you use the wrong nomenclature, because to that extent you have included persons who should not be included. So if you say trade payables to micro, small, and medium enterprises, you are wrong. You'll have to say trade payables to micro and small enterprises and to others. So similarly, for not only companies but for non-corporates also, there is a requirement to disclose. Additional requirement coming out of the MSMEDA Act like this. Based on the information available with the entity, one has to actually disclose these many details. I will not get into the details, but this particular annexure which we give in the disclosures of every company has to be given in even for non-corporates. Let me spend a couple of minutes on MSC's 43BH. Now, all of us are knowing what is 43B. 43B means any expenditure which is booked shall be allowed as an expenditure if it is covered under 43B, if it is paid till the due date of filing the income tax return, which means for a normal person who's not going in for tax, who's going in for audit, but not for the purpose of transfer pricing, 31st October is the last date. So until 31st of October, if you have any dues falling in the family of 43B, like a GST, like bonus, like incentives payable or gratuity, all these things will be allowed even if it is shown as payable in 31st of March, only on the actual payment if it is paid within 31st of October. Although 43BH was introduced last year in the last year's budget, as in 43B, it does not belong to the normal 43B A to G category. So there they made out a carve out for 43BH, saying that if it is not paid before 31st of March and due date under the MSMEDA Act has got expired, then it shall not be allowed in that particular year, even if it is paid before 31st of October. So I'm sure all of the chartered accountants who are aware of this particular provision. The risk is, the problem is, how do I report it? I'm talking about the reporting aspect. Now there is another aspect to it. If the due date on 31st of March is still not exhausted as per the MSMEDA Act, let us say I have supplied it on, now what is the due date? What is the due date under section 15 of the MSMEDA Act for a MSME supplier? Sorry, MSE supplier. Every supplier who is a micro and small enterprises shall be paid within the agreed period, which shall not be more than 45 days. And if there is no agreement, then it shall be paid within 15 days. So if I have an agreement and say that I'm going to pay to a supplier after 75 days, then in that context, 45 days will become the cutoff, because agreement between the supplier will be will be against the act, will be ultra virus the MSMEDA Act, because MSMEDA Act says the supplier shall be paid within 45 days as per the act, even if the agreement says otherwise. However, the agreement says I shall be paying the supplier within 30 days, then 30 days is okay. If I don't have an agreement, 15 days. Or if I have received some material and I have not rejected it, that this is also put into place. If I have not rejected it, then it is deemed to be accepted if I don't, as a buyer, inform the supplier about the defect in the goods within 15 days from the date of supplies. So these are all the aspects to be known when the company is dealing with a supplier who is a micro and small enterprise. And the disclosures I have already told you for the financial statements. And now let's talk about the income tax 43BH and tax audit report, because tax audit report also the auditor has to now report in the tax audit report. On the financial statements, I report supplies dues on 31st of March. But here, maybe when I go into the clause 22 of the 3CD, form 3CD, where in fact, initially it was told under the 43BH, I have to classify this the disallowances under 43BH. But then in the corrigendum which was issued initially, as I am sure all of you know, on 5th of March 2024, our tax audit report got changed. They brought in certain additional features, including 43BH. At that stage, that was included under 43BH clause. But later on, there was a corrigendum issued on 19th of March 2024 to say that this does not belong to the 43BH family, 43B family. It rather belongs to clause 22, where we talk about disallowances under section 23 of the MSMEDA Act. That is, if such a supplier is not paid within the agreed period of under section 15 of the MSMEDA Act, he shall be paid, the supplier shall be paid interest at 3 times the bank rate, and such an interest will not be allowed for income tax purpose. This is what was told under section 23 of the MSMEDA Act. Now, along with that, they said any disallowances under 43BH of the Income Tax Act. So we'll have to bring out any disallowances for not paying within 31st of March to such a supplier, having the due date exhausted. If the due date is persisting beyond 31st of March, then if I pay within such a due date, now I am telling you, I bought something from a supplier on 20th of March, and there was no agreement. So which means 15 days, which means maybe 4th of April, I should pay him. So if I pay him on 5th or 6th of April, then that will not be allowed for the assessment year 24-25. So that is how it happens. Now, how do I report it? So for the purpose of reporting, I need to have a proper classification at the time of buying itself. I need to know whether the supplier is a micro and small enterprise. I need to make controls at that stage. Now, having done the control at that stage, I will have a list of vendors to whom dues on 31st of March. Please understand that if they have skipped beyond the due date during the year but paid by 31st of March, then it shall not be subject to disallowance. So, however, having skipped the due date, but on 31st of March, it is still payable, it is shown under your trade payables. So, what you will have to do is on the payables, you will segregate to payables to micro and small enterprises and to others. And within the micro and small enterprise payables, you will segregate further to trade, purchase from traders and others, because traders are not subject to 43B disallowance. And with the other than traders, that is manufacturing or services, then what you will do is it outstanding from last year? Then it was debited to the P&L account of last year, and last year this provision was not there. So I will be excluding those creditors which were there from the opening balance. And on the balance, I will further see whether these were due on 31st of March. If they are not due on 31st of March, I will say put them into a second list and say within the second list, have they been paid by within the due date in the subsequent year within the due date? If so, they will not be disallowed for 43BH. Otherwise, they will also be added to the first list and disallowed for the purpose of 43BH. So not only trade payables, could be under other payables, outstanding expenses, and so many other places. So now, how is it as an auditor I have to report on this, and how should my audit, I should proceed with my audit procedure? Now, first of all, I mean, like in any other case, here also we can do a test check. The primary responsibility of collecting, segregating, and getting the information is that of the assessee. We tell all this in the tax audit report in clause 3 of 3CA or clause 5 of 3CB. We bring in all the wordings as in SA 700 to say it is the assessee's responsibility to fill in form 3CD, and it is his responsibility to get all the information. My job is to do a test check, and I am doing it as per the framework as mentioned in the guidance note of tax audit. So I'll have to tell all this in my tax audit report. And then in addition to that, I will also say that the assessee is responsible for identifying and classifying the suppliers into micro and small categories as per MSMED Act. And he is responsible for providing a list of trade payables and current liabilities to whom amount is outstanding as on the last day, along with the working of disallowance under 43BH of the Act required to be reported under clause 22. I'm telling that it is his primary responsibility. I'm doing a test check. Where am I telling that? I'm telling it in SA 700 type of words, which I already put in and I was always putting. So I am entitled to do the test check, and I will do a test check. And please understand, primarily, I have to find out whether the classification done by the auditee, the assessee, is proper. I will check up whether the auditee has properly segregated, taken strains. He cannot just say, I don't know. I mean, no, we don't know who are the suppliers. We will have to. It becomes our responsibility. Tomorrow, at the time of assessment, if the assessing officer writes a letter to all the suppliers and they say that I am an MSE, and if that MSE is outstanding on 31st of March, he may disallow. So whatever steps the assessing officer takes, as an assessee, should take it beforehand, failing which the auditor on a test check basis will also have to look into, or failing which otherwise also the auditor will have to do on a sample basis to find out whether any of the suppliers are indeed micro and small enterprises. So what we have done is, to all the assessees, we have told that you should get a letter from the vendor saying that he is either a micro and small or otherwise. And if he is a micro and small, then comply with all the requirements. And in case they don't reply, you send a second reminder and a third reminder saying if you don't, then we presume that you are not a micro and small enterprises. For our institute has come out with this year on the implementation guide on the changes to the tax audit report, wide notification 5th March 2024, wherein they have told a few things about this particular disallowance under 43BH. One of the things that they said is a supplier will be considered as micro and small only if he provides to the buyer the Udyam registration. And point number 2, if he is registered during the year, if he is registered during the year, he will be considered as micro and small only from the point of time for all the purchases done up to that particular point of time. He will not be considered as micro and small enterprise, although that amount may be payable as on 31st of March. Similarly, if he has ceased to be a micro and small during the year, all supplies done until that particular date will also be considered as for the purpose of disallowance under 43B(h). And point number 4, they said traders are not to be considered for the purpose of micro and small enterprises. So let me now move on to the last topic, which is the mistakes that are normally found out. Since Abhilasha wanted me to cover these topics, I have put it under 4 buckets: the accounting standards mistakes, the standards on auditing mistakes, the Companies Act mistakes, and generally hygiene or housekeeping mistakes. Quickly, I will run through these 4 slides. Accounting standards, non-compliances, reference to wrong frameworks of accounting standard, accounting standards of ICAI for companies. I mean, it cannot be Institute of Chartered Accountants of India's accounting standard for companies. Although our institute prepares the accounting standards, finally it is rolled out from the company accounting standard rules or Ind AS. So you cannot refer to the institute's accounting standards when you are doing the accounting standards for companies. So that is a mistake. And companies accounting standard rules read with Rule 7 of Accounting Standard Rules 2014. The moment you say read with Rule 7 of Accounting Standard Rules 2014, then you have made a mistake. So all until 2021, there was no accounting standard rules under the Companies Act 2013. There was 1956 Act, and for that 1956 Act, there was a Companies Accounting Standard Rules, I think, issued in 2006. Yeah, 2006. The rules were in 2006. Till 2021, we had to, under the 2013 Act, refer to 2006 rules. And Rule 7 said, till such time accounting standard rules are made in 2013's Act, you follow the 1956 rules as in 2006. So that was the bridge. So we used to say we are following the company's accounting standard rules of 2006, read with Rule 7 of Accounting Standard Rules 2014. Now, if you are using this Rule 7, then you are wrong, because right now, under the Companies Act 2013, there is a rule, Companies Accounting Standard Rules, rolled out in 2021. So for all companies, we'll have to say that we are following the Companies Accounting Standard Rules 2021. That's it. You cannot refer to Rule 7 anymore. Not using standard words. The words which are used in the standards are very, very sacrosanct. You cannot misplace them, which will altogether give a different meaning. For example, if you're writing off long-term investments, you'll have to say that I am writing off long-term investment. I mean, long-term investments are always carried at cost unless there is a drop in the value for reasons other than temporary. The moment I say I am recognizing the drop when there is a permanent drop, if I use the word permanent, maybe I have committed a grave mistake, because there is temporary, there is permanent, and other than temporary somewhere here. So I have to recognize the impairment in the long-term investments sooner than later. Similarly, when I create deferred tax liabilities, the words used is timing reference in Accounting Standard 22. Although in Ind AS equivalent, it is called temporary differences. So in Ind AS, you have to use temporary differences. In accounting standards, you'll have to use timing difference. Accounting Standard 1, disclose only significant accounting policies. This is only a noting point. Exception, inventories, revenue recognition, and borrowing cost, even if they are not significant, but they are there. What I mean is, if the company does not have a borrowing cost, you can altogether drop the disclosure on significant accounting policy on borrowing cost, because there is nothing. But if there is borrowing, although it may not be significant, the Accounting Standard 16 says you shall disclose the accounting policy with respect to borrowing. So you shall disclose it. Otherwise, only significant accounting policies need to be disclosed. Now, disclosure must neither be inadequate nor excessive. This is what has been told by the Schedule 3 itself. Then Accounting Standard 2, all of us give cost. I mean, we will say that the inventories are valued at cost or net realizable value. Lower of cost and net realizable value. Lower of cost and net realizable value. Again, a point to be noted: ICDS, income computation and disclosure standards uses the word cost or net realizable value, and accounting standard 2 uses the word cost and net realizable value. So for accounting standard, you shall use lower of cost and net realizable value, and for ICDS, you shall use or net realizable or. So that is a succinct difference. And if you interplace those two, then also the FRRB will say if you use or, they will say it is a mistake. And TAQRB, Taxation Audit Quality Review Board, will say if you use and, they will say that is a mistake. So be wary of such minor, what should I say, minor housekeepings also. So cost, so what happens is cost or net realizable value, whichever is lower, I mean lower of cost and net realizable value. And cost, may we need to say what is the formula, whether we have used the FIFO, whether we have used the weighted average. Only these two methods we can follow. We cannot follow LIFO or in a simple average method. So you'll have to say within the cost, you will have to spell out whether you have followed the FIFO or the weighted average. If that is not told, then it is deemed to be a mistake. Similarly, under the cash flow statement, in fact, you will be surprised to know that the highest number of mistakes are found out in the cash flow statement. For the reason, I tried to understand the reason. The reason is the amount of importance we give for the balance sheet and profit and loss account. We don't give the same amount of importance to the cash flow statement. Maybe we will see the balance sheet, the profit and loss account, the schedules, the notes, and the income tax computation, and leave the cash flow statement to the article trainee. And article trainee, being a trainee, he will know to the best of his knowledge, he will do it. But there could be some investment activity put under financing activity or under the operating activity, and there it could be a mistake. And there is a requirement for you to specifically tell the breakup of cash and cash equivalent, the policy with respect to cash and cash equivalent. In one of the companies we had seen, what was capital work in progress moved to become a property, plant and equipment. The company said, we have sold the capital work in progress and got back the money, and we have spent towards the property, plant and equipment. Whereas it cannot happen like that. Capital work in progress becoming plant and machinery is the point. So what happens is, this goes and this comes. It is not as though this is sold and this is bought. So in the cash flow statement, it was made to, it was looking as though the capital work in progress was sold and property, plant and equipment was bought. So you will have to gross value and accumulated depreciation is not disclosed in accounting standard 10 and accounting standard 13. Normally, I think people tend to follow the WDV, especially for proprietorship concerns and partnership firms. They tend to follow the WDV as per the Income Tax Act, whereas the requirement of accounting standard 10, which also applies to proprietorship concern and partnership firms which are subject to audit, they need to give gross value and accumulated depreciation. Also, lack of giving useful life and depreciation rate is a mistake if you don't give that. Accounting standard 15, lot of mistakes. Compliances with respect to provisioning, disclosures not properly made. Even if the company is not 5 years, there may be a requirement for you to provide for gratuity because you are expected to have a life of more than 5 years. Maybe the employees are not less than 5 years. You need to estimate how much of your employees will be working beyond 5 years, and for them you need to make a provision right from now onwards and not when they become more than 5 years old. So actuarial report needs to be questioned. Actuary is not a god. He could make a mistake in his assumptions. So please ensure that those rates are not the assumptions considered are all what should I say, proper and related to the actual activity of the companies. So disclosures for the comparative period, there is a requirement for you to give the comparative period. And when it comes to AS 15, there is a requirement for us to give disclosures for the comparative for the last 4 years under para 120N of the accounting standard 15. A lot of people don't make proper disclosures with respect to accounting standard 18. I will skip this. I will go forward. Schedule 3, there are a lot of non-compliances observed. The nature, whenever we talk about the other assets, other current liabilities, or other income, there is a requirement for us to show what is the nature. We'll have to disclose the nature. If it is not disclosed, then it amounts to a non-compliance. We need to put what is the nature. You just can't leave other current assets. Anything which is told under others, as an auditor, I need to be suspicious. And just like I am suspicious, maybe the reader becomes suspicious. We need to let them know what it contains. Give the nature. You don't have to really give the amounts against that particular thing, but you should say it contains income tax refund due, or whatever you want to say, you will have to tell there. Showing outstanding expenses under provisions. This, in one of the financial statements which we are reviewing, we saw that the provision for audit fee is put under short-term provisions. Although the word is provision for audit fee, the items that should go under short-term provisions are those provisions on which you do a substantial degree of estimation. The definition under accounting standard 29 on provision is a liability where a substantial degree of estimation is involved. In the case of an audit fee, there is no estimation involved. It is already contracted. We know 1.5 lakhs, 3 lakhs, 4 lakhs, whatever we have already contracted has to be put in. So it is more a case of trade payable. In fact, our institute has gone to the extent of saying it is a trade payable, and not an item to be fit to be put under short-term provisions. Similarly, payment to auditors. I have seen companies putting the internal audit fee, the cost auditor fee under auditors. Let us be very clear. Auditor in relation to Companies Act means the statutory auditor. And when they expect you to give payment to the auditor, only the payment that is made to the statutory auditor should come there. Whereas the payments to the cost auditor or the internal auditor or any other auditor will have to be put under professional fee. Comparatives for all items have to be given, including property, plant and equipment. We have seen that property, plant and equipment, the last year figures are not given. Although opening balances, additions during the year, closing balances are given. And let us say property, plant, we bought a property, plant and equipment. Below the additions, how much of property, plant, and I bought 10 crores this year. How much I bought last year? Let us say 3 crores. So that should also be, every line item should have a comparative in the financial statement. Rounding off is a must. Rounding off is must. And earlier, once the Companies Act Schedule 3 got revised, companies rounding off is a must. Most of the companies are doing it, but then they are suddenly in the notes to accounts, they're using amount in rupees. So what is told is rounding off a must, and all through the financial statements. It cannot be suddenly a full figure item. So everything should be rounded off. Reference to note on the face of profit and loss account. If for every item that is coming in the notes, there should be a proper cross-referencing. We have seen that items like earning per share, which is there inside, but we have calculated and said 3.11, and there is a note, the reference to that particular note is missing. So debtors considered doubtful, ensure to make provision for every item which is shown under debtors considered doubtful. So let's go to the non-compliances in the audit report. SA 700, 705 and 706. So 700 is a clean audit report, unmodified opinion. 705 is a modified opinion which can be of 3 types: disclaimer, qualified and adverse. So mostly we may use the qualified opinion. And SA 706 deals with emphasis of matter and other matter paragraph. So we must understand that emphasis of matter is a matter which is a matter in the financial statement properly dealt with, and I as an auditor, and it is properly dealt with, and a proper note is given in the financial statement. But I as an auditor feel that I need to highlight that particular aspect, that it is properly dealt with. But because it is of so much of significant importance to the user of the financial statement, I'm drawing the attention by putting the point in the emphasis of matter in the audit report. So we have seen that people are misusing the emphasis of matter to put some of the qualifications. What was supposed to be put under qualification is put under the emphasis of matter, which is a serious issue. FRRB, when it comes to such matters, can refer the matter to the disciplinary committee, because what was required to be a qualification is put under the emphasis of matter. It is not like emphasis of matter is a via media between modified opinion and a qualified opinion. I can give one of the examples. Recently, a company had not provided for gratuity and had not worked out some of the bonus payable. And then the company in the note, they went on to say that we are unable to find out what is the future liability, and they had put it under the contingent liability. They had put it under the contingent liability. Whereas it cannot be a contingent liability. What is a contingent liability? The probability of the occurrence is lesser than the probability of occurrence. So the non-occurrence is higher than the probability of occurrence. So that is the contingent liability. Where the occurrence is definite, only the amount is not known, amount is not certain, we will have to somehow make a provision. That is what is provision. Provision is a liability measured using substantial degree of estimation. So if you are putting it under a contingent, if the company has put it under a contingent liability, I as an auditor will have to qualify that particular financial statement. And I cannot say, use the emphasis of matter to say that, the company has only provided a contingent liability, look at that. So that was a grave mistake. So never use notes and accounts for audit qualifications. Never use notes and accounts for audit qualifications. Balance confirmation certificate not available to us is told in the financial statement. Now, let us be very clear that the financial statements are authored by the management and the audit report is authored by the auditor. We cannot crisscross. The management cannot author the audit report, nor the audit report auditor can author the financial statement. If you put something like this, balance confirmation certificate not made available to us in the notes, it looks as though the auditor has put his words in the notes. That is absolutely not acceptable. So if at all balance confirmation is not made available, then I will have to say in the qualified audit report, or to the extent if it is very pervasive, I may have to disclaim the audit report altogether. Balance shown under sundry debtors or creditors is subject to reconciliation and confirmations cannot be in the financial statement. If it is there, I have to qualify. Inventories as certified by the management. Let us be very clear. Everything in the financial statement is certified by the management. Why only inventories? I mean, it looks like, the auditor has relied on this aspect considering the certificate by the management, while you are entitled to go in for collecting a management representation letter, but that cannot be a substitute to your actual audit process. Any like this will be considered as a non-compliances. Then I'm coming to the casual approach, which is not tolerated. The casual approach, let us say in the audit report, we are supposed to say the financial statements reflect with respect to the balance sheet, the financial position, and with respect to the profit, the statement of profit and loss account, the profit is true and fair. The profit is true and fair. In some of the financial statements, the company has profit for both the years, this year and the comparative year, but they have said profit bar loss is true and fair. If you are using the word profit bar loss in your audit report, then I'm afraid that you have made you are taking a casual approach. You wanted the reader to tick whatever it is. As an auditor, it is my obligation to come out with the proper aspect. Similarly, note numbers mismatch. I mean, I've told that the earning per share is note number 32, but when I go to 32, it is talking about contingent liability. So the note number should also be perfectly. It can happen, now last minute changes and things like that. But last minute changes also is for the auditor and the company. Even in the last minute or the last breath, you will have to do a perfect job before sign off. Profit and loss account instead of statement of profit and loss. What we have to refer to in the audit report is not a profit and loss account. We don't anywhere, we always used to say final accounts consists of balance sheet, statement of profit and loss, cash flow statement, statement of changes in equity, and notes. So we don't have any more a profit and loss account. Profit and loss account means a T-shape where we have a debit and credit. We have a statement top and down. So we have to refer it as statement of profit and loss. And clubbing accounting policies and disclosures and making a mess of it. Hygiene factors. Good to mention. I mean, I would say the last aspect is the hygiene aspect. Previous year figures. I mean, it is good to give that previous year figures. Sometimes when I look into the last year's annual report, it will not be there. Then I will better to say that it has been reclassified into regroup or reclassify wherever necessary to conform to the current year requirements. And my last of all, I will have something called the rounding off error. Rounding off errors. There could be 10.5 and 10.5 will actually be looking as 11 and 11 if I'm rounding it off. But when it's actually calculated, it will come to 21. When the computer will calculate it as 21, but apparently if somebody calculates, it comes to 22. So I will have to tell them that rounding off error, due to this rounding off, numbers presented throughout the document may not add up precisely to the totals and percentages may not precisely reflect the absolute figures. So I will have to say this And look at your watches. Learning never exhausts the mind. So with that, it's
My
7 o'clock.
God, I'm breaking the flow and I have to intervene over here. Sorry, Raksha, I'm doing your job. Intervening the MC and speaker both. But sir, literally at 7 exactly, you're done with all your. It was a rapid fire session, and my God, small things which we don't even look at it actually. Literally now I feel like what all I have been doing in the last 1 month, have I done it correctly or I should go and change it, considerably. So thank you so much for your time and thank you for accepting the session. Over to Raksha.
Sure.
Thank you.
Oh, thank you so much, sir. Thank you, Abhilasha. Now I would like to welcome Mr. Aditya for Q&A session.
Hello.
Yes, Aditya, please go ahead.
Yeah. Thank you so much for the wonderful session we had, and especially those minor issues that normally any practicing member should be aware of, and from the management side also they should be aware of. Otherwise, it was a very good session and quite a learning experience for all of us. Thank you so much, sir.
Thank you, Aditya. But are there any questions? Yeah.
There is one on the chat box which says, under section 43BH, whether PO can be taken for agreement for MSc.
The answer is yes. Purchase order. Who gives the purchase order? Let us put it like that. Purchase order is signed by both the vendor and the supplier. I mean, the supplier and the buyer. So therefore, any document I only say that the invoice given by the MSc supplier may not be agreement, because the other party has not accepted. But if he signs that, that becomes an agreement. If he signs that, it becomes a agreement. So purchase order, in my opinion, definitely is a agreement.
Then can company use the sentence balance of creditors or debtors are subject to confirmation? That you have already answered in your
The company can use it. If the company has used it, I as an auditor will have to qualify it, and if it is pervasive, maybe disclaim. So that cannot be what should I say, an astra for me to do less audit than otherwise required.
well, audit trail reporting for small companies where the accounts are maintained by tax consultants.
Yeah.
So according
no
to me,
small
it doesn't
company,
matter who maintains it.
Absolutely. So small company or large company is not the criteria, whether your books of accounts are on electronic mode or otherwise. Are you writing the books of accounts, or are you maintaining the books of accounts on electronic mode? If you are maintaining it on electronic mode, you shall have the feature of audit trail, whether such books of accounts are maintained by the company or by an outsider. As I already told you, if it is maintained by an outsider, the auditor will have to look into whether such an outsider's outsider has to do the entity to find out whether the audit trail is there in such a system. Otherwise, he will have to get a certificate from the auditor of such an outsider, and then rely. And again, reliance is depending on his own risk. I mean, now we have SA 700, which is being SA 600, which is being the subject
Revised.
matter of big debate. Yeah.
There's one question on 43BH where the invoice date is 31st March. Tax audit is concluded on 10th of April. On the date of audit, 15 days time is not over. Subsequently, the assessee pays to the supplier after 15 days window, say on 25th April. How is the situation be handled by the assessing officer?
You will have to file a revised audit report. I mean, like we have the situation where for all 43B, including bonus, this year it's particularly Deepavali and Dasara is happening in October, but we have to sign off all our tax audit reports in the month of before 30th September. So we may disallow that in 43B clause, but under Rule 6G of the particular Rule 6G of the income tax rules provides me to amend and revise my tax audit report for all other purposes, bonus including 43BH.
Then there's a question. A supplier is registered under Udayam. He is both a trader and manufacturer. The assessee purchases trading goods and not manufactured goods. Does 43BH apply in this case?
No, I mean, it's a very tricky question. So I always say, if it is a traded good, then it should not apply. It should not apply. And to that extent, we may, I mean, I don't know whether it is supplied through the trade or manufacturing. So take an undertaking from the supplier to say that it is out of the trading goods, and that could help. And the best way to take a undertaking is to say that he is not an MSME at all. I mean, that's what we are telling. Take an undertaking that he is not a MSE. Even if he is registered, he can give an undertaking that I am not registered. That's the best way to come out of such a situation.
So this last question, in SAP, every transaction has details created by, edited by, and approved by, instead of a separate report. In this case, whether company complied with audit trail feature.
No, in a SAP, what is the question? It has
I'll
got.
just repeat it. In SAP, every transaction have details of created by, edited by, and approved by, instead of a separate report. So they are looking at whether you literally need a log of all the changes, or transaction level, I have the audit trail. Is that sufficient?
No, it should be at every level. I don't think just that who has done it is not sufficient. When it was done, when it was deleted, if at all any changes have happened, all those things have to be done. Just not the name, but when, who is one aspect of it. When it was done, whether it was done at all those things have to be done. Normally in SAP we have this feature, but please ensure that all features are covered. Get into the reading of implementation guide. It gives you all various scenarios.
Yeah, just one thing on SAP and other ERPs. So largely they are having the audit trail at the application level and not at the database level. That is also something which many of the auditors are also commenting in the audit report.
I think if you have any doubt, better to comment it what you understand. It is there at the application level, but not at the DAM level, right? You're talking about DAM level.
Yes.
Yeah. Data administration management, whatever it is. I've seen a lot of reports, and in our own Karnataka Bank, our auditors have commented that it is there at the application level, but not at the DAM level.
Good. Then Caro applicable for small companies, as guidance notes given some criteria. I think Caro applies based on criteria applied.
No, for small company it's not applicable.
Yeah. So I think that's all the question that we have in the chat box.
I think there's one more from
is
last.
it applicable for non-active company? That's the last question coming up.
So there is no, again, I would say, if you are not active, if you are maintaining the books of accounts on manual basis, then no problem. But even if it is a non-active, I mean, what I've seen is such companies write their books of accounts only in the month of September. September 1st and 2nd, they write the books of accounts. No problem. As long as the tally has the feature, maybe the officer will come to know that the entry as of 30th September 2023 was passed on 1st September 2024. No problem. Still, I can say that the company has a feature of audit trail. As long as I can know when it was passed, who has passed, all those things. And if there is any deletion, if it can capture everything, no problem. Even if it is a small company and you have passed it on 1st of September 2024, you can say that the company has got the feature of audit trail.
I think there are no other questions in the chat box.
I can only say thanks to Chaturvedi. I always keep telling this, Abhilasha. And for you, I have kept the Chaturvedas here. I always keep telling. And,
my goodness.
Yeah. I said
Companies
these are the
Act, Income Tax Act.
No, Income Tax Act, I'm not talking.
Okay, Companies Law, Code of Ethics.
The Char Vedas for the purpose of reporting today are, one is, of course, the Companies Act. One is the Companies Act. The second one is the auditing, standards on auditing. The third one is on the accounting standards. And the fourth one is the Code of Ethics. So these are the four Vedas which we need to imbibe, read in totality, even if we miss Samaveda, Atharvana Veda, Rig Veda, and Yajur Veda. Well, that is important, and that is how your name comes. I think these are the four Vedas. If we are mastering, I think we can call Shri Raksha also as Shri Raksha Chaturvedi. And Abhijit Pai also change Pai to Abhijit Chaturvedi. I think chartered accountants, all chartered accountants,
with these
all of us need to become Chaturvedi. You cannot say I'm a Trivedi or a Dvivedi. That will not help if you have to do the audit in totality. Thank you so much.
Thank you very much, sir. We can formally, please, thank you, sir. Let us formally give a vote of thanks. Thanks a lot.
Thank you so much, sir. And now I would like to welcome Mr. Abhijit to deliver the vote of thanks.
Yeah. Good evening, everyone. I'm deeply honored to have the privilege of delivering the vote of thanks today. First and foremost, I extend my sincere gratitude to CAK Gururaj Acharya sir for his clear and insightful explanation of the key points discussed during the session, including audit trail, MSME-related compliances, accounting standards and audit report non-compliances, and of course, the Chaturvedas. I also thank KSCA President CA Vijay Kumar Patel and CA Abhilasha Chaturvedi, the chairperson of the Coral Committee. I would like to acknowledge the invaluable guidance and support of CA Ravishankar sir, the esteemed mentor of the Coral Committee. His wisdom, dedication, and mentorship have been instrumental in driving our efforts forward. We extend a heartfelt thanks to him. My appreciation also goes to the KCA Technology Committee and the team for their seamless management of all IT-related requirements. Further, I would also like to thank Ms. Hema and Mr. Mohan, the admin staff at the KSCA, for their continuous support. Thank you to KSCA for organizing this valuable, knowledge-enriching webinar and to all the attendees for your participation, which made this event a success. Once again, my heartfelt thanks to everyone involved. This is CA Abhijit Pai, member of the KSCA Coral Committee, wishing you all a productive and insightful continuation of your professional journey. Thank you.
Thank you.
Thank you so much, Abhijit. Thank you, everyone. We'll meet in the next session. Thank you.
Thank you. Thanks.